In March 2020, a storm hit us, a storm of epic proportions called COVID. Now, COVID attacked us so surreptitiously that we were taken completely off guard. It took along our near and dear ones, it took along our jobs, our means of livelihood, our economic wealth that we had created till the time the pandemic hit us. Now, such life changing events have a deep impact on our minds. As a natural instinct, when we are faced with an adversity or when we are in a risky, tricky situation, our natural instincts tell us to find shelter, to go for cover. But because of this incidence, because of the COVID that came into our lives, this perspective for many people has taken a 180-degree turn. The way you look at life has completely changed. You never know if you're going to be there in the future to plan for it. So, why not live in the present? Why not make most of what you have? A good theory to live in peace. But is this good enough for investing your money? I doubt. The basic tenets of investments still hold true, COVID or no COVID. You see many people entering into fad investments like cryptos and IPOs, and I'm very sure not even half of them have studied what they are putting their money in. What is the product? What is the risk? Is there any future? If is there any legal recourse if they face any problem? Half, or I can confidently say more than half of the people don't even know what they are getting into. It is a fad thing that many of the people are doing, so let's do it. See, investing is not about how much you are investing. Investing is more about where you are investing. Asset allocation is the key to creating long term wealth. Now, what is asset allocation? Asset allocation is investing your money in different asset classes. Now, not all of us have the same capacity to digest risk. Not all of us can take risk. Some of us need that peace of mind. Some of us need less risky instruments to have a good night's sleep. Is there anything wrong in it? I don't think so. It is based on individuals' psychology. Now, depending on that, if you go for fad investments, are you not going to lose your good night's sleep? You definitely are. So, then the safest way to create wealth, the safest way to increase your money is by investing in different kinds of asset classes, some of which are less risky, some of which are riskier. Now, see, basically, there are 5 asset classes: equity, debt, gold, cash, and real estate. Now, equities, all of us know, means investing in the shares of a company, either through primary markets, which is the IPOs that the company comes out with, or secondary markets, like investing in already listed shares of the company through stock exchanges. Now, equity is a high risk investment product. If you have the appetite, the returns that the equity investments will fetch cannot match with any other returns any other investments will give you. So go for equity if you have the risk taking capacity, if you have the risk taking appetite. The longer you remain in the equity market, the better the returns you are going to fetch. Equity is one of the most essential ways of fighting inflation. World over, there is a huge risk of inflation, with China and US seeing the top 3 economies, rather China, US, and Japan, coming out with their inflation figures, which is at an all-time high in the last 40 years. Now there are supply chain bottlenecks. The raw material prices are increasing. Many companies have increased their product prices to stay afloat, and inflation is here to stay for a considerable future period of time. Now if you want to beat inflation, that is how you're going to increase your money. Equity is a go to investment product. Debt. What is debt? Debt is a kind of loan you give to a company or to a bank or to the government. Now, debt instruments in comparison to equities are less risky. They being less risky, the returns are also comparatively less than equity returns. You get returns in the form of interest that is paid by the banks or the companies in which you invest in their debt instruments. One thing that needs to be checked while investing in debt is whether the returns that you are getting out of the debt are beating the inflation rate. Because if they are not, then then the value of your money is actually decreasing rather than increasing over a period of time. So, to check whether the return on your debt, the post tax return on your debt, are more than the inflation is a very important factor before investing in any debt instrument. You can invest in fixed deposits in banks, debentures in a company, fixed deposits of corporates or government securities in debt instruments. If you have a low risk appetite, debt is the investment product for you. Gold. Now, many of us Indians do not see gold as an investment. Why? Because gold is Lakshmi. Gold is what is purchased and kept and passed on from generations to generations. So, I am not sure if people buy and sell gold from the point of view of making money. But if you are looking for gold as an investment instead of buying jewelry, I would suggest go in for digital gold, purchase ETFs, exchange traded funds, or gold funds for that matter. Now, gold also can be a way to beat inflation, and it will help you not give returns regularly like dividends in equity or interest on debts, but you will be able to cash in on the gold only once you sell your investment. The fourth type of asset class is cash. Cash is what? Liquidity. Liquidity is a necessity. Liquidity is needed to fund your day to day routine expenses. You need to have liquidity for smooth functioning of your daily living. How much money will you keep in cash is a big question. Not much. You cannot just put all your money in cash. Why? Because it is not going to help you earn any returns. And with the inflationary trends that are flowing worldwide, the value of the cash holdings is going to come down. In the sense, what you would purchase with the cash that you have today is not what you will be able to purchase 1 year hence because of inflation. So, investing money in liquid assets, investing money which will give you fair amount of returns, is absolutely important. Keeping money in savings or liquid funds is a better way because it at least helps you earn 3 to 4% in case of savings and 6 to 7% in case of liquid funds. And you can withdraw money from the funds, and you can withdraw money from your bank accounts as and when the need be. Now, only your expenses for the next 2 to 3 months can be kept in liquid cash. Rest of the money needs to be invested in short term or long term, depending on the perspective or the goals that you have set for yourselves. The last in asset class is real estate. Now, real estate can be in the form of a residential flat, residential property, or a commercial property, or a vacant piece of land. One thing that you need to be absolutely clear is that the house in which you are living cannot be termed as your asset. Why? Because it is not going to give you any financial returns. The emotional quotient of investing in a house is very high, but do not term it as your asset. When you invest in real estate, the amount of investment that you need is very high. The lock-in period for which you need to keep the money in that asset is also high. But again, the returns are also comparatively high. On the liquidity front, real estate is not suggested if you want short term liquidity, or if you want your asset to be converted into cash as and when the need arises. Real estate should be an asset for the long term. Real estate should be an asset to create long term value, to create long term wealth. It should not be a short term asset. So, equities, debts, gold, cash, and real estate, 5 asset classes. Distribute your money in these asset classes. It is necessary to have money, some amount of investments in all the 5 types of asset classes. Why? Because it will ultimately help you in increasing your returns and reducing your risk over a period of time. It will ultimately help you in creating value for your money. It will help you in creating wealth in the long term, and that is how you plan your money. Do not plan it on the basis of an incident which has hit us once in a century. This is a phase, it will pass. Think from long term and plan properly.